If you zoom out far enough on history, a disturbing pattern appears. Great empires almost never die because some enemy stormed the gates. Most of the time, they die from something far quieter and more technical. Their money stops working. Not overnight, not with a single announcement, but in a predictable sequence that repeats over and over again. First comes expansion, then overspending, then the quiet cheating of the currency, then inflation, then the loss of trust, and finally, collapse. You can see this pattern clearly in the stories of Rome, Spain, and Britain. Rome's legions dominated the known world for centuries, its roads and aqueducts unmatched, its silver coin trusted from one end of the Mediterranean to the other. Spain, after the discovery of the New World, sat on more gold and silver than any other power in history, and for a time it looked unstoppable. Britain, at its peak, ruled a quarter of the planet's people and land, and the pound sterling was the backbone of global trade. And yet each of these empires followed the same 7 steps to self-destruction. They stretched their militaries too far. They promised more than they could pay for. They turned to debasing their money or flooding the world with it. Prices rose. Faith in the currency eroded. Foreign lenders backed away. And eventually, the political and military structure built on that money crumbled. The names change, the costumes change, but the script stays the same. The most dangerous part is that the people in charge always think they are the exception. Roman emperors believed their power was eternal. Spanish kings thought infinite silver meant infinite wealth. British officials convinced themselves that the pound could absorb any shock. Every elite told themselves that this time is different, that old rules no longer applied to their special empire. Every time, they were wrong. Now, in the middle of the 21st century, the United States sits in the same position the others once held. It is the dominant military power. Its currency is the world's reserve. Its financial system reaches into every country. But the same warning signs that flashed for Rome, Spain, and Britain are blinking again. Massive debt, relentless deficits, endless foreign commitments, inflation, and a global shift away from its money. This documentary is not about predicting a date on a calendar. It is about showing you the pattern. We will walk through how Rome destroyed its own silver coin, how Spain's silver drove it into bankruptcy, how Britain's pound lost its throne, and then we will hold those stories up like a mirror to the United States today. Once you understand the sequence, you can no longer tell yourself that what is happening now is random. You see that it is stage 5 of a script that has been performed 4 times already. The only question is how close we are to the final act. To understand how money can bring down an empire, we start with Rome. At its height, Rome ruled tens of millions of people across Europe, North Africa, and the Middle East. Its armies were feared, its roads and aqueducts were marvels, and its coin, the denarius, was the lifeblood of its economy. When a Roman citizen or soldier held a denarius in his hand, he knew exactly what it represented, a small but reliable chunk of silver. When the denarius was introduced, it contained a consistent amount of pure silver. That was the secret of its success. Merchants knew it, soldiers knew it, tax collectors knew it. That trust allowed Rome to trade efficiently, pay its legions, and fund its building projects across the empire. As long as the government honored that purity, the system worked. But empires are expensive to maintain. Each new frontier added more cost, more legions to defend it, more roads to connect it, more bureaucracy to govern it. Rome began to spend more than it received in taxes and plunder. Rather than cut back or raise taxes to unbearable levels, emperors chose the hidden path, changed the money itself. If you could quietly reduce the silver content but keep the same face on the coin, you could pay your bills today and hope no one noticed the difference. Early emperors tampered only a little. They shaved a fraction of the silver, stretching the metal to mint more coins. On the surface, nothing changed. The coin still bore the emperor's image and the same name, but under the surface, the substance was different. Over time, that temptation grew. By the 3rd century, the denarius had been hollowed out from nearly pure silver to mostly base metal with a thin coating. Imagine being a Roman soldier in that era. Your grandfather had been paid in solid silver. You were being handed pieces of metal that looked similar but bought far less. As more and more debased coins chased the same amount of grain, oil, and goods, prices surged. What once cost a single coin could eventually cost dozens. Ordinary people didn't talk about monetary policy. They just knew that their wages couldn't buy enough bread. The reaction was predictable. Farmers stopped trusting the coin and demanded payment in goods or gold instead. Merchants raised prices constantly or refused to sell for debased currency. Soldiers, who were the backbone of Rome's power, grew restless and demanded real value for their service. Tax collectors found it harder to gather enough to send back to the center. The gears of trade and administration began to grind. Notice what did not cause the initial breakdown. It wasn't a barbarian invasion crashing through the gates. It wasn't a plague or an earthquake. Those came later as symptoms of a weakened system. The core wound was self-inflicted. Rome destroyed the trust in its own money to paper over deficits. Once the currency's value collapsed, everything built upon it, armies, roads, bureaucracies, lost their support. By the time the Western Roman Empire formally fell, the process of decay had been running for generations. When people say Rome died, what they often mean is that its money died, and the state that relied on that money couldn't survive. The first proof of the pattern was written in silver. Overextension, debasement, inflation, loss of confidence, and finally, collapse. Jump ahead more than 1,000 years, and the empire at the top of the world is no longer Roman, but Spanish. After voyages of exploration and conquest in the Americas, Spain found itself in control of territories bursting with precious metals. The discovery of enormous silver deposits in the Andes turned a remote mountain into a money fountain. For decades, ships crossed the Atlantic loaded with bullion, pouring wealth into the royal coffers. From the outside, it looked like the perfect formula for permanent dominance. Spain had a steady stream of silver, a formidable navy, and colonies that stretched across continents. Its silver coins became one of the first truly global currencies accepted in Europe, Asia, and the Americas. Just as the Roman denarius once had, Spanish money carried a reputation for reliability. Merchants trusted it. Governments held it. The empire basked in what seemed like unlimited resources. But there is a paradox at the heart of money. If you flood the system with it without increasing real production, you don't make the society richer, you just make prices higher. As silver poured into Europe, the amount of metal chasing the same amount of goods multiplied. The result was what historians now call the price revolution, a long period where prices rose several times over. Wages didn't keep up. People blamed merchants, foreigners, or bad harvests. But the core driver was simple: too much money. Spain compounded the problem by how it used its windfall. Instead of building a diversified domestic economy, encouraging industry, and laying the foundation for long-term productivity, the crown spent lavishly. Wars were fought on multiple fronts. Palaces were built. Luxury goods were imported from other countries. Much of the silver that flowed into Spanish ports flowed right back out to pay foreign suppliers and creditors. Despite being the richest empire on paper, Spain repeatedly found itself unable to pay its bills. Kings borrowed heavily, assuming the silver would always be there. When revenues and war costs collided, they defaulted. Each time, trust in Spanish credit eroded further. Lenders demanded higher interest or refused to lend at all. In response, the government resorted to the old trick: altering the coins, reducing their metal content, mixing in cheaper metals, pretending they were as good as before. People noticed. Just like in Rome, confidence slipped away. Merchants discounted Spanish coins or refused them entirely. Inflation, already high from the silver flood, was made worse by debasement. The empire found itself in a trap. Dependent on foreign goods, deeply indebted, losing the trust of markets, and reliant on a money supply it no longer fully controlled. Over the next century, Spain's power ebbed. It still had colonies, but its influence weakened. Rivals such as England and the Netherlands took over trade routes and financial leadership. The empire that once sat on half the world's silver discovered that metal alone cannot save you if you borrow irresponsibly, spend without discipline, and undermine your own currency. The pattern repeated in a slightly different costume. Sudden wealth, overspending, debt, currency manipulation, inflation, loss of confidence, and slow collapse. By the 19th and early 20th centuries, a new empire had taken the top seat: Britain. Its flag flew from the Caribbean to India to Africa. Its navy dominated the seas. Its language and legal system spread across the globe. Underpinning this reach was the pound sterling, anchored to gold and trusted above all other currencies. For a long time, the pound was what central banks held, what trade was invoiced in, and what investors sought when they wanted safety. The British system looked more disciplined than Spain's. The gold standard bound the pound to a fixed weight of gold, restraining politicians from simply printing their way out of trouble. For a while, it worked remarkably well. Credit flowed, trade expanded. British finance sat at the center of global capital flows. As long as the government did not overwhelm its resources and its currency linked to gold, it could manage its debt. World wars shattered that balance. The First Great War of the 20th century forced Britain to borrow on a scale it had never imagined. The cost of maintaining armies, fleets, and supplies pushed national debt to heights that dwarfed pre-war levels. To fund these costs, the government suspended its strict commitment to gold and created more money, just as Rome had altered its silver and Spain had flooded Europe with metal. After the war, British leaders tried to turn back the clock. They restored the gold standard at the old exchange rate, pretending that nothing fundamental had changed. But everything had changed. The economy was weaker, rival powers were stronger, and the pound at that old level was too high for reality. Exports suffered. Unemployment rose. To defend the overvalued currency, interest rates were kept high, which strangled growth further. The attempt to preserve prestige damaged the underlying economy. Within a few years, the strain became too much. Britain was forced off gold again, this time for good. The pound was devalued and trust took a hit. Yet the real blow to its monetary empire came after the Second Great War. By then, Britain had sacrificed everything to win militarily. Its cities were bombed, its industry exhausted, its debts enormous. In the post-war negotiations that redesigned the global financial system, the pound lost its status as the primary reserve currency. The dollar took its place. From that point on, the story was one of gradual but relentless decline. Britain tried repeatedly to stabilize and defend its currency, only to face runs on the pound and painful devaluations. Each step down eroded domestic savings and signaled to the world that the old imperial money was no longer a safe anchor. At the same time, maintaining far-flung colonies became impossibly expensive. One by one, territories gained independence. Military adventures, like the Suez Crisis, revealed that Britain no longer had the financial or geopolitical strength to enforce its will. By the 1972nd, high inflation and economic stagnation pushed Britain to seek help from international lenders. The pound, once a symbol of strength, had become a symbol of vulnerability. The empire itself had largely dissolved, not because some rival conquered London, but because the financial foundations of its power had crumbled. Again, the pattern is clear: war and overextension, soaring debts, abandonment of sound money, devaluations, inflation, loss of reserve status, and imperial retreat. Rome showed the pattern with silver. Spain demonstrated it with New World treasure. Britain proved it with the pound. 3 empires, 3 currencies, 1 script, which brings us to the present reserve currency, the United States dollar. Today, the United States stands in the position Rome, Spain, and Britain once occupied. Its military presence spans the globe. Its financial system touches every country. Its currency, the dollar, has been the world's primary reserve since the middle of the 20th century. Oil, global trade, and central bank reserves have all been built on it. But if you line up the 7 stages that destroyed past empires, the uncomfortable truth is that America is marching through the same sequence. The story begins with dominance. After the Second World War, the dollar was tied to gold, and other currencies were tied to the dollar. This made the U.S. currency as good as gold in the eyes of the world. Confidence was high. American economic power, industrial capacity, and gold reserves supported that trust. The first stage looked solid. Strong military, growing economy, respected money. Stage 2, overextension, followed. The United States built networks of bases and alliances, fought expensive conflicts abroad, and layered on domestic promises, from welfare programs to entitlements that locked in rising costs. Like Rome's legions and Britain's global commitments, the U.S. posture around the world is extremely costly to maintain. Stage 3 is persistent deficits. Year after year, the federal government spends more than it takes in. It borrows to cover the gap, issuing ever more debt. For a while, a reserve currency issuer can get away with this. Demand for its bonds stays strong because everyone needs its money. But when deficits become structural and debt grows faster than the economy, the trajectory becomes unsustainable. Stage 4 is currency debasement, the modern version. In earlier empires, this meant literally changing the metal content of coins or flooding markets with silver. Today, it means creating new digital dollars in massive quantities. Since the financial crisis of 2008, the U.S. central bank has injected trillions into the system under the label of quantitative easing and emergency stabilization. During recent crises, more money was created in a short period than in many previous decades combined. The effect is the same as Rome's shaved silver. More units of money chasing roughly the same real resources. Stage 5 is inflation. Prices rise, sometimes slowly, sometimes suddenly. Official statistics may downplay it, but ordinary people feel it in rent, food, and energy. Trust in the purchasing power of the currency starts to erode. People who lived through stable decades begin to ask why everything costs so much more and why their wages struggle to keep up. Stage 6, loss of confidence, begins at the edges. Foreign governments diversify their reserves, holding fewer dollars and more gold or other currencies. Alliances of countries build alternative payment systems. Trade deals are struck in non-dollar units. Central banks quietly accumulate precious metals. On the domestic front, savers question whether their cash and bonds will hold value. The shift is gradual until it isn't. Stage 7 is the end game. The currency loses its special status, or in extreme cases, its basic functionality. For a global reserve currency like the dollar, that would not just be a national event, but a global shock. Every central bank, every multinational corporation, every trade contract tied to the dollar would feel the tremors. History offers 3 broad pathways: a slow, managed decline to a lesser role, a chaotic collapse where trust breaks suddenly, or a painful but deliberate reset into a new system, perhaps one tied to gold, a basket of currencies, or digital alternatives. The United States has not yet reached the final stage, but by the logic of the pattern, it is no longer at the beginning either. High debt, persistent deficits, repeated money creation, rising prices, and a visible move by other nations to reduce reliance on the dollar all suggest we are closer to the confidence-breaking phase than most people want to admit. The point of looking at Rome's denarius, Spain's silver, and Britain's pound is not to indulge in doom for its own sake. It is to recognize that empires do not get a special exemption from arithmetic. You cannot spend far more than you earn indefinitely. You cannot endlessly dilute your money without consequences. You cannot maintain an expensive global footprint forever on borrowed funds. 4 times in 2,000 years, great powers convinced themselves they were different. 4 times, the pattern ground on anyway. Today, We are living inside the 5th run of that script. The timeline is unknown, but the direction is clear. Understanding the pattern doesn't fix it, but it does prepare you for what may come when the world finally decides that the reserve currency of this era is no longer worthy of its throne.